World's largest sovereign wealth fund warns investors to buy inflation hedges. From the Financial Times, world's largest wealth fund warns permanent inflation will hit returns. Equities and bonds to suffer as steep rise in rates becomes lasting feature of economy, says Norwegian oil fund boss. The world's largest sovereign wealth fund has warned that investors face years of low returns as a surge in inflation becomes a permanent feature of the global economy. Consumer price inflation is running at its highest level for more than 2 decades in the world's biggest industrial economies, in particular in the US, where the annual pace of price growth hit 7% in December. Tangent said the oil fund, which owns the equivalent of 1.5% of every listed company in the world, thought inflation could be stronger than what is generally expected as the world experiences high demand and lingering disruption to supply chains. I 100% agree. And as the goes away and restrictions are lifted and all of this savings, all of this new currency starts going, really that demand picks up. At the same time, we've just destroyed production and we've destroyed supply. And, there's talk of price controls. There's talk of even more government stimulus, bigger deficit spendings. This is insane. He goes on and says, we are seeing it across the board in more and more places. You saw IKEA increasing prices by 9%. You've seen food prices going up, continued very high freight rates, trucking rates, metals, commodities, energy, gas. We're seeing signs on wages as well. The former hedge fund manager said, how will it pan out? It hits bonds and shares at the same time. For the next few years, it will hit both. The market measures of inflation expectations suggested investors were not overly concerned about runaway inflation. One popular gauge, the 10-year break-even rate, showed inflation moderating from today's levels to roughly 2.5%. The 2-year measure indicated inflation would remain above 3% in the near term, but Tangent said other factors, including more people retiring or leaving jobs, strengthened his view that the rises were permanent. Now, I think it was Jesse Felder who argued this point, or it might have been Joseph Wang, aka the Fed guy. One of those two was talking about people retiring, which is going to, that wage inflation, that lack of labor. I guess we'll wait and see. Both bonds and stocks started 2022 on the back foot, and investors' long-term expectations from mainstream capital markets are becoming gloomier. AQR Capital Management, a quantitative investment group, estimated that a classic balanced portfolio of 60% stocks and 40% bonds would return just 2% annually after inflation over the next 5 to 10 years. This is under half the roughly 5% average enjoyed over the past century. Large investors have sought to beef up returns with alternative investment strategies, including hedge funds, venture capital, and real estate. Their assets under management grew to $13.3 trillion last year, according to data provider Preqin, which predicted the alternative investment industry's assets would grow to $23.2 trillion by the end of 2026. The mandate of the oil fund, housed in Norway's central bank, includes only stocks, bonds, and real estate. It had its fourth strongest year for returns last year, posting a 14.5% increase. It has grown steadily since the GFC in 2008, but Tangent warned that could be coming to an end. We will have much tougher times ahead, with extremely low interest rates and a very high stock market, and with increasing and in some places accelerating inflation. We could see a long period of time with low returns, he said. Now, I'll put a link in the description to this article, and you can all read it in full yourselves. Ray Dalio is warning against transitioning away from fossil fuels too quickly, and also says that cutting off the supply of finance to the industry would have a destabilizing effect as inflation soars. He's 100% right, and I've been talking about this on this channel for quite some time, and it's one reason why I think this decade is going to be very inflationary, simply because of the craziness in the energy market. Now, this chart's slightly a little bit old. It's a few days old, and the food UN Food and Agriculture World Price Index has just hit an all-time record. So, yeah, energy's going up, food's going up. And Spain PPI, 35.9%. Wow, that is insane. And here, the City Inflation Surprise Index, US versus Europe, shows it. Look at the Eurozone. And we've got a CPI issue. We've got an inflation issue in the US. And look at Europe. This is just crazy stuff. Crazy stuff. And then we had Christine Lagarde say, look, we're not going to raise rates. So, yeah, maybe we'll raise them to zero, so they're no longer negative. And Powell's inflation will be transitory claim back in April. How's that working out for him? Not working out too good, is it? And here in Australia, our CPI came out at 3.5%. Yeah, rubbish. But non-discretionary came out at 4.5%. And it's non-discretionary that really hits the poor and middle class most. And so, our CPI numbers aren't as bad as the US and Europe yet. However, if you have a look at the import costs, Australia, we don't manufacture a lot. If you have a look at the import costs that have just come in the last week, it was up a lot. And all of that is going to be passed on very soon. So, yeah. So with all the demand, with all the new credit creation, all the incentives that the government and the central bank have done in terms of lowering interest rates, but making credit available through government guarantees, through withdrawing retirement funds to use as a deposit, we've had huge demand. And even in our business, so we have a finance broking business on the east coast of Australia, in Queensland, New South Wales, and Victoria. And we've just written record numbers in the last 2 years in terms of mortgage growth and loan sizes. Loan sizes have jumped up the fastest pace I've ever seen, and I've been in this game for 18 years now. And have a look at just in less than 2 years some of the growth in house prices. Brisbane, 45%, 48% in Hobart, 47% in Canberra. Is this a crack-up boom that Mises has warned us about all those years ago? Are we seeing a crack-up boom? And household prices and household debt, the correlation is very, very tight. And here you can see just in the last 18 months, the huge spike in, this is average loan sizes for owner-occupied dwellings. Now, investors have jumped back into the market now. Investors are now driving the Australian housing market. First home buyers have really dropped off the ball. Owner-occupiers have dropped off as well. It's investors that have really picked up the pace in this market. So there's a lot of borrowing going on and a lot of speculation in the property market. So this increase in debt needs to continue if we're going to see the continued growth in property prices. So you need to ask yourself, what is the likelihood of that happening? And this is a great chart. So this shows the new loan commitments, and you can see that growth in mortgage debt. So the trend line, have a look at the trend line there, and then have a look at the explosive, almost vertical in new loan commitments. And these monthly loan commitments must remain elevated or the housing market busts. And you can see in 2017-18 when, and I've shared in other videos, where Aussie housing, especially Sydney and Melbourne, fell, 10 and 12% respectively in that 12-month period. And that's because we saw that loan commitments falling. So if interest rates do rise, and if APRA, the prudential regulator, does bring in restrictions on credit, are we going to see these monthly loan commitments remain elevated? Because if they don't, and I've talked about in other videos about the borrowing capacity as interest rates are dialed down. So according to the RBA, the Reserve Bank of Australia, every 1% in rate cuts increases housing by almost 30%. So once again, if rates are going to go the other way, what does that mean for house values? So we're already seeing values falling, the growth falling in all Australia's major capital cities, except for Brisbane and Adelaide, as you can see there. So if this trend continues, and as we see rates rise, this is going to be a very big issue, especially for people who bought into the housing market with very minimal deposit over the last several years. And Australia's household debt, we take the gold medal with household debt to disposable income almost at 200% now. And have a look at where it's come from 1989. So just in the last 30 plus years, it's pretty incredible. Now, this chart's slightly a little bit old. The household debt service ratio has ticked up, and that's even at record low interest rates. So if interest rates rise, what does that mean for household debt service ratios? Well, once again, Australia takes the gold medal here. So this chart's a little bit old as well, but a couple of points or a couple of things that stand out here is you can see after March 2020, when the cough started, you can see that people really increased their savings and increased their amount in their offset account. They were building buffers, but in time that has come down. So there's a lot of talk out there that there's buffers in people's offset accounts. Well, the data that we're seeing from our own client base, and we've got well over 10,000, 11,000 clients with a loan book of over $5 billion, we're seeing borrowers with very little in their offset accounts now. There were huge amounts. The other thing to note is the scheduled principal. So that's the blue part. This is showing that the loan sizes, the principal, are much, much bigger. And interest as well. You can see that as rates have gone down, interest has gone down. Now, some people argue, well, they're just paying more principal than they are interest. And there is that argument. But we're just seeing much, much higher mortgages, debt. And as interest rates rise, well, that interest component is going to go up significantly, and that is going to chew out a lot of the people's disposable income. So what are we looking for in terms of cash rate? Well, when we look at the ASX 30-day interbank cash rate futures yield curve, the market is predicting by May 23, so that's a bit over 12 months away, we're looking at 1.55% cash rate. What does that mean in terms of mortgage rates? Well, we're going to be looking at between 4 and 5% mortgage rates. So if you've got a mortgage right now, go work out your repayments at between 4 and 5% and see how that's going to impact your budget. Now, what about the Fed? Well, the probability of 125 basis point rate increases this year is 98.9%. So the market is thinking that both in Australia and the US, that rates are rising very, very soon, and there's going to be quite a number of rate rises. But for more information about what that all means for the housing market, I'll put a link in the description below to this video that I did. It goes for about 48 minutes, so I've put a lot of information in here and what I think, what will happen, and I've given a lot of empirical data in this video, what will happen if these rates do rise that the market is expecting. And big congratulations, everyone. The US national debt is now hit $30 trillion. What an awesome achievement that is. And this is where I start to question the market about raising rates. With government debt the way it is around the world, and now we've got a problem with government debt here in Australia. Remember, around the GFC, we had no net government debt. Now we're sitting on over $1 trillion in government debt. So, and for the size of the Australian economy, that is quite big. The US, as the size of the economy, the GDP, is still much larger than here in Australia. But how can rates rise with all this government debt? And then how do they do quantitative tightening? How do they unwind their balance sheet? We saw what happened in 2018 when they tried quantitative tightening. The market plunged 20%, and then Power did the power pivot and went, "Oh, we're sorry. Please don't fall." And so this is, I guess, this is where I'm battling as an investor. Is it's all determined by central banks right now. There's no fundamentals in any market other than gold and silver, which I'll come to. It's all driven by central banks, central bank intervention in the bond market, in the mortgage-backed securities market, in the stock market, housing market, you name it. It's all because of central banks. And so not only do we need to question, rate rises, how many rate rises until the market starts imploding? A lot of people don't think it's going to be many at all, and they're going to have to stop. And let alone quantitative tightening. How do you do that? How do you unwind the balance sheet? You're just going to blow up the bond market. Rates are going to skyrocket. You're going to have corporates go under. It's going to be a mess, and markets are just going to crash. And this is where your David Hunter's talking about 80-90% market crash may well happen. We may see a 1929, 1930 massive stock market crash followed by a massive depression. So you got to ask yourself, will central banks and governments allow that to happen? I mean, what they've shown so far is no, they won't allow that to happen. They will continue to keep doing what they've been doing to prop up asset prices. The problem then is you're going to have super high inflation. You're going to have currency being devalued. And this is where you want to own inflation hedges. And here, percent of treasury bonds held by central banks versus total federal debt outstanding. And for everyone that talks about, I think this chart's a little bit old because I think the US is pushing towards 30% now. But this is a problem all around the world. It's not just a US Fed-centric problem. Central banks around the world are becoming the largest buyers of outstanding debt. And so this is what I say is, how can they unwind this? How can they do quantitative tightening? The bond market's going to blow up and rates are going to skyrocket. And with all that corporate debt out there, from junk all the way through to even, AAA, prime. So it's very clear. We have a central bank bubble. So all the different bubbles we've had along the way, we definitely have a central bank bubble. It is all driven by central banks. And some argue that, 2008, we should have allowed the reset to happen. We should have taken the pain and reset the economy and get back onto, a sound path. But we didn't. And central banks just came in and just did this big experiment, this quantitative easing experiment. And everyone thought, oh, yeah, this is going all right. There's no hyperinflation yet. And markets are doing all right and whatever. But now we're reaping what we've sown. And our economy is so weak. Our economy is holding up asset prices, stock market. If the stock market goes down, there goes the economy. And it shouldn't be that way. The stock market should be a reflection of the economy, not the other way around. So I've shared this chart before in previous videos. Falling margin debt growth from high levels triggers a sell. Watch this closely, because we've got huge amounts of margin debt in the system. Huge amounts of margin debt. I mean, we've got huge amounts of debt in every asset class. But, this one's going to be quite dangerous. Because then you get these phone calls. And I'll be honest, I've had a few of these phone calls in the past. During the GFC, I I had some margin calls, and I actually haven't had any margin debt since the GFC. I've got a margin account sitting there with zero balance. I haven't drawn on it since the GFC. So, yeah, you don't want one of these calls. And if we do see it, then I believe we're going to see this bubble absolutely pop. Absolutely pop. It's clear we've got a central bank bubble. That central bank bubble has blown bubbles in just about every asset class. It's blown a bubble in bonds. It's blown a bubble in stocks. It's now blowing a bubble in real estate. And the only thing it hasn't blown a bubble in, and that's gold and silver. So for more analysis on what all this could mean for the stock market, I'll put a link in the description below to this video I did, sell, because I don't want to spend too much time on this. So with inflation obviously an issue, everyone is now warning of longer lasting inflation, of CPI increases, of the devaluation of our currency and savings and income. Yeah, the question has to be asked, what can central banks do? They've really trapped themselves. They've backed themselves into a corner. Do they raise rates to fight inflation and then destroy asset prices, destroy the bond market, the stock market, the property market? Do we have an almighty crash in those things? Because the crashes are going to happen big time in those because they've bubbled up so much due to central banks. Or do central banks raise a little bit and then go, oh, we're sorry, we're doing a power pivot. We're sorry, we're turning around. Please don't hurt us. Or do they just keep talking rubbish like Christine Lagarde at the ECB? Well, if they do that, gold and silver is going to absolutely skyrocket. It really is. People are then going to... there's still a lot of people out there thinking that this is transitory, that we're going to face deflation. And, especially if they... And a lot of people believe that rates are going to 3-4%. The cash rate going to 3 or 4%. I can tell you the bond market, stock market, and property market will have well and truly bursted way before we even get to that point. Way before we even get to that point. Now, they might want to do that. They may want to crash asset prices. They may want to do that. That might be part of their plan. I don't know. But if they don't, well, even if they do, you can see here in this chart where the S&P 500 has crashed, gold and silver, especially gold, but silver as well, relatively stacks up quite well, especially in terms of purchasing power. But if they don't, and they keep rates low, and they cap yields, and we have negative real rates continuing to grow, and we see CPI up and down, but remaining high over the years ahead, people are going to lose faith in central banks. They're going to lose faith in the dollar and in local currencies, and that inflation problem is going to become even worse. And that's when people are going to really jump into gold and silver, and especially silver. It's a much smaller market, and we're going to see huge spikes in silver. And I did a video the other day, last week, with Casey Research talking about $190 silver. If you haven't watched it, I'll put a link in the description below, because this type of scenario is where that kind of projection could play out, where you don't just get, gradual increases in the price of gold and silver. You get huge spikes, in particular in silver. And so, when we look at, the advice of, these big sovereign wealth funds that are warning about inflation, warning about rising rates, talking about buying inflation hedges, well, what do you buy? Well, you can buy real estate, but that's in a bubble. That's overvalued, and it's linked to a lot of debt. There's a lot of debt holding that thing up. So do you buy that? Do you buy farmland, which is overvalued at the moment? Commodities. A lot of commodities look good to me. Some have risen. Energy. Even though energy's had a big run, I still think energy looks good, and definitely on any pullbacks, pick up some energy. But the most undervalued asset, the most undervalued inflation hedge is clearly gold and silver. And when the capital starts flowing into this market, there are going to be huge price spikes. Anyway, that's my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you again on another episode of Finance Uncut.